Is it a blessing or a curse that financial institutions should value their assets at market value? At first blush, it might seem obvious that that's what one should do, but many are arguing that if you hold something to maturity, you can value them at cost or whatever reasonable model you come up with. Well, financial institutions haven't been all that reasonable. At least that's what the markets think, because people don't want to do business with banks that are unreasonable. There's no trust. The trust is very, very difficult to get back into the system. Part of the challenge is that it's extremely difficult to value these assets. Even the most prudent companies have a difficult time with that. A company like Goldman Sachs uses a model based on expected future cash flows. They have been valuing their assets lower and lower as the economy has been weakening, but still these prices are much higher than the price you would find in the markets. Part of the reason is that nobody wants to sell anything in the markets, because then they truly would have to value these assets at market value. So they try to do everything not to value them. There's a solution to all of that. In our view, to fix these issues, we need to adjust the value of the books on financial institutions every single day to the market value. Now, that may not be possible with off-balance sheet derivatives, but it is possible if derivatives traded on regulated exchanges, and that's what we need. On a regulated exchange, I'm thinking of a futures exchange like a Chicago Board of Trade or an options exchange there. In that instance, what happens is that every single day, if you have a gain in your position, you receive some money, and if you have a loss accrued that day in your position, you get a margin call. You have to supply more funds. Take the situation of a trader that bets on falling oil prices, and the market was rallying at the time, going through $100 a barrel, zooming up to $140 a barrel. If that person had any leverage whatsoever, odds are that person may get wiped out. Now, should we bail out that trader because oil ultimately went down to $40 a barrel? In my view, not, because the rules are clear that this is the collateral you have to post, and if you have a leverage trade and you have a period where it may be, or the market believes that the trade goes against you, then you have to supply the appropriate funds, because nobody has a crystal ball to know what the future will bear. And as a result, financial institutions would be more risk averse because they know that risk may apply. We don't mind anybody speculating, even using leverage or significant leverage, but if and when they fail, they must not cause a systemic risk to the system. They cannot bring everybody else down. And that's exactly what a regulated exchange achieves. The press secretary, the White House press secretary, the other day tried to ridicule the Chicago Board of Trade for being part of the problem. He did that when Rick Santelli had his comments on the Chicago Tea Party, Rick Santelli of CNBC. In our view, you're throwing out the baby with the bathwater if you do that. There are serious issues in the banking system, but the regulated exchanges are part of the solution. Indeed, regulated exchanges are typically profitable. That means tax revenue for Uncle Sam. You don't get tax revenue for Uncle Sam if you limit the bonuses of CEOs, even though they may deserve it right now. The point is, you have to put the incentives in place for prudent risk management, and fair value accounting is the way to go. And as painful as it is, one has to weed out the insolvent banks. And again, you don't do that by propping them up or by having the government partner up with them to tell them what jets to fly and what furniture to put in place. You do that by dismembering the insolvent financial institutions, selling them off so that we have good banks rather than bad banks. If we don't do that, economic activity is not going to resume, and it's going to be extremely expensive. We believe it might be extremely inflationary in the U.S., what we're pursuing right now, jeopardizing the U.S. dollar, and that's where our home quarter is. We publish a newsletter at Merk Insights at merkfund.com, comment especially on currencies. Please sign up at merkfund.com, and we look forward to seeing you again in another video here.